Hey, Steve Saretsky here. As always, this Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. I obviously appreciate your support. A little bit of housekeeping before we get into this video. The latest edition of the Saretsky report is out. It's basically a detailed analysis and summary of the Vancouver market, Canadian real estate, all sorts of graphs and charts that you probably won't find anywhere else. It's really it's a compilation. It's basically going to highlight everything that's happening in the market. It's between 10 to 15 pages every month. So if you want to look that up, I highly encourage you to do so. There's going to be a link to that below in the comments or in the description. And basically what it's going to do is it's going to take you to a landing page where you're going to have to enter in your email, and then it will automatically download the report. That email is then collected and used only to send out the updated version each and every month. So there's no extra emails or spam that you're going to get through that. Simply just to send you the next month's report. So again, I highly encourage you to check that out. Now, as we get into it, this video is going to be a little bit longer today. There's obviously a lot going on at the end of the month. I'm going to talk on the detached condo market, bigger picture, credit markets, etc. Everything that I'm seeing from not only a data perspective, but a feet on the ground perspective, talking with lots of different mortgage brokers, realtors, finance people, people connected in the banking industry, etc., to sort of provide an outlook for you. As I've mentioned in previous videos, previous reports, everything, I've really talked about the detached market being sort of a lead indicator, particularly in Vancouver. If you looked at the first quarter of 2018 sales, I had mentioned that it was a 27-year low in the city of Vancouver. I mean, there's really no other way to slice that data or to try to analyze it and try to find any sort of bright spots. I think it really speaks for itself. Now, as I said, I didn't expect to see any sort of rebound in April or in the coming months ahead when you tacking on a stress test, obviously higher borrowing rates, speculation taxes, luxury taxes, I just didn't see how that's going to be optimistic for that segment of the market. Sure enough, as we're seeing in April, detached sales, again, they hit a 28-year low for the month of April. So if you take every April over the last 28 years, going back to 1990, which is as far back as my data set goes, it was the fewest amount of sales in the city of Vancouver. I mean, this is sort of the reality situation. This is where we are today. You know, it's hard to sort of quantify prices again because there's so few transactions that there's almost no price discovery. And as a good example of this, I'll try to explain it to you, is if you actually go back and look at, again, I'm not going to compare the two, but all you can really do is look at historical context to understand financial markets. If you go back and look at Arizona's real estate bubble, back in 2008, when that thing burst, you actually had sales peak out at around 2006. They declined in 2007. They declined in 2008. And you really didn't start seeing those rapid price cuts until later on. Prices actually bottomed in 2012. But what happens is the prices have to get cut for the sales volumes to pick back up, because obviously buyers are willing to hold out. Sellers are still unrealistic. They're still starting to get a gauge for the market. They're still sort of trying to squeeze a little bit of profit out of the house. And so there's really not that price discovery. And so it's almost like that holding pattern. And in order for sales volumes to pick up, it's almost as if prices need to be slashed so you can sort of get that new price discovery and sort of a new understanding of the market. So I think in Vancouver's aspect, again, nobody really knows how this all plays out. But if I was to say that, there's clearly a holding pattern where 28-year low in sales, buyers aren't willing to buy at the current prices. So sellers that need to sell have to cut their price. And I think right now, obviously, buyers are willing to be more patient. I don't think sellers are going to be able to hold out much longer. They're going to have to get more realistic moving forward. That's simply the reality of the situation. Inventory levels, this is what happens, right? We've had detached sales now for almost 2 years, just continually trend down. Inventory levels as a result have been creeping up. They are now, I believe, at a 10-year high for Vancouver detached inventory for sale. And so you have a multitude of factors working against you in that segment of the market, right? Record low sales, record high inventory, rising interest rates. Again, all these things that I've talked about in the past. So we'll be watching that market moving forward. Maybe a market that is probably more relevant to the majority of people in Vancouver. Actually, I just want to quickly touch on that detached before I move over into the condo segment, because I always think it's good to sort of get a context of everything. So one of the big reasons is we know that the detached market, given the prices, particularly in Vancouver, where your average sale price is around $2.5–3 million, it's a market that is predicated on foreign capital coming in and supporting it, and I've talked about that numerous times, particularly in Richmond, where I grew up. It has the highest concentration of foreign buyers. I believe prior to the foreign buyers tax being introduced in 2016, foreign buyers, per the BC government data, clocked in at about 18% of transactions. That's official government data. Now, I would argue it's probably lower, but we're not going to get into that, or sorry, higher than that. But so Richmond, on a foreign buyer transaction base, is the highest. Detached sales for the month of April also hit a 28-year low, but it's important to really look at those sales numbers. So there are only 65 detached sales in Richmond in April of 2018. The second previous low, so again, if you go back all the way to 1990 and say, okay, how many detached sales were there in April? It was April of 1995 when there was 90 sales. So 65 sales. The previous low was 90 sales in April of 1995. Here we are in April of 2018. We've set a new low of 65 sales. I believe on a year-over-year basis, it was a 48% drop. And keep in mind that 2017 was a bad year for the Richmond detached market. So it's obvious that the foreign buyer bid is pulled back. I mean, you've increased the foreign buyers tax from 15% to 20%. Now you're including a speculation tax. So that's definitely scared that portion of the market off. So I think we're about to witness how resilient the Vancouver market is, or how dependent it is on foreign money coming in and supporting it. Now moving over into the condo market. I think it's a market that is starting to get tested. Obviously, this has been it's been the market that has been driving the growth over the last year and a half. It's been supporting the market, despite what the detached market has been doing. The condo market has continued to push prices higher and higher and higher. And I said, from everything that I can see, it is mostly a local market. The foreign buyer sort of been pushed to the side. It's what locals can afford. So they've really been driving up, particularly the one-bedroom condos. But what I'm seeing now is clearly a turning the corner, so to speak. I'm very, very hesitant to say it feels like a top in the condo market, but there's definitely something going on here. If you look at Vancouver condo sales, in April, they were the lowest they've been in the past 5 years, since 2013. But if you pull that back even further, other than 2013, this was the second lowest since going back to 2006. So sales have really been dropping over the last couple of years, despite the sales dropping, because the inventory levels have been so low, the prices have been pushing up higher. But that price growth is really starting to slow down. The average and median price for Vancouver condos shows 12% price growth on a year-over-year basis. Obviously that's still tremendous growth, 1% a month. But what's more important is putting that again into the context, into the bigger picture. The Vancouver condo market has been, growing annually by 25 to 30%. So this 12% is effectively cutting that price growth in half. And I would argue that over the last 3 or 4 months, I really haven't seen much price growth in the Vancouver condo market, particularly as soon as you get out that one-bedroom segment. So that's very interesting to look at. I mean, I do think that sales volumes tend to fall first, and obviously we were seeing that in the condo market. But it's really been a story of there's just been no inventory, so that's why every time the fewer buyers that are out there are getting into multiple offers, because there's no inventory. but we're now starting to see that inventory come up. It increased by 8% year over year. New listings surged by 34% year over year. So that's been a huge shift, because what we've been experiencing over the last year and a half is new listings keep falling and falling and falling. Nobody wants to sell a Vancouver condo. Well, here we are, increased by 34% year over year, Vancouver condo listings. Now, a huge part of this is to look at is to unpack all of this, right? I don't want to just throw some numbers at you, because it can be a lot of numbers to digest and understand, but try to framing this into the whole entire picture. You have Vancouver condo sales trending downwards. Okay, you have inventory starting to creep up, still very, very low. New listings obviously skyrocket in April. I'm gonna keep an eye on that. I think that's an important metric. But I think a huge part of that new listing story and what the inventory story moving forward is going to be a continued weakening of sales, which is what we saw in the detached market. The detached market inventory levels increased not from a surge in new listings, but increased from just no sales happening and inventory levels just multiplying. So we're going to watch for that in the condo market. But new units under construction in Greater Vancouver reached a record high as of the end of March. It reached 42,000 units at an annualized pace under construction. Of course, new units completing also hit a new high. And then we have housing starts also still at a new high. So you are basically, what's happening here is a sort of a classic, this is a classic real estate cycle where you have a huge influx of credit starts to decline, sales start to decline, developers overshoot new construction, so you're overbuilding into a decreasing demand market, and that tends to always overshoot, and this is how typical real estate cycles are. So I mean, you have, again, like I said, 42,000, that's nearly double the long-term average of units under construction. So you have all this new supply coming to the market. So all these pre-sale buyers that bought these units, they're now closing on them. A lot of them aren't end users. They're either going to rent them out or they're going to resell them. And so these are starting to hit to the market. They're starting to add to the inventory levels. And I think that's going to be an important story moving forward, because we have about 2 more years coming up where all the supply, this record supply, is just going to keep coming for the next couple of years. Because like I said, housing starts are at a record high. You know, that's usually at least 2 years out until it completes. So there's not going to be any slowdown in new construction coming to the market, and I think that could flood the market into a market where we're seeing declining sales. So it's very, very important to watch moving forward. And as I've said, always in the bigger picture of things, it's always about, you know, yes, foreign buyers matter, but mortgage credit, I mean, locals, we are starting to see those credit taps really start to tighten. Mortgage credit growth over the last 3 months has been growing at its slowest pace in nearly 2 decades. And that is, I mean, that's huge. It's so important, because as I mentioned, like, this whole mortgage credit growth and household debt bubble is now coming to a very interesting point, again, where you have rising interest rates. Just last week, RBC, TD, and CIBC all increased their interest rates. As per rates by, this is going to, depending on what Scotiabank does, and who's the other one, I can't remember on the top of my head, there's almost certainly going to be a higher benchmark on the stress test. It's going to move up higher because it depends, like the Bank of Canada basically looks at what the other banks are doing, and I guess they set that rate. So the benchmark of the stress test is going to move up. I believe it's about 10 or 15 basis points here in the next couple weeks. So as per rates by, they estimate that's going to reduce borrowing power by an additional 1.5%. And again, you have mortgage credit growth clearly decelerating. again, growing at its lowest pace in nearly 2 decades, on top of these slowing sales. So it's important, and it's an interesting dynamic listening to David Rosenberg, chief economist, really smart guy, very, very well respected in the industry, talking about, he was on BNN the other day talking about the Bank of Canada and the precarious situation they're in. Basically, you know, they are affected by what's happening in the United States, and the United States is full steam ahead on these rate hikes. And Rosenberg says the Canadian bond yields are about 90% correlated with what's ever happening in the United States. So despite what Stephen Plows, who also in a speech last week talked about household debt, he basically said, to summarize his speech, he basically said, we have no idea what direction we're going. They say they see the neutral rate where they want to get the overnight rate, which is now 1.25%. They see the neutral rate closer to about 3%, meaning that's ideally where they want to be. They want to get from 1.25 to 3%. They feel that at 3%, it's basically neutral, means that interest rate isn't stimulating the economy, but it's not dampening it either. But it sounds like in that speech, there's no way in hell they're going to get to 3%. So they're very cautious on moving forward because they're watching all these multitude of factors, and he talked about 2.1 trillion in household debt. 8% of households have a debt to income ratio, I believe, of 350%. They're just highly leveraged, so the Pelosi is very nervous about moving forward, and obviously the impacts that's going to have on the real estate market. But again, as Rosenberg said, he might not have a choice. He's like, these mortgage rates that are still ratcheting higher, that's tied almost 90% to what's happening in the United States bond market. So how much control does he have over that? That's extremely important moving forward. So we'll have to wait and see how that all shapes up. Anyways, that's about it. Don't want to ramble on too much further, but obviously, again, if you have any questions, comments, put those in the description below or in the comments below. We'll banter back and forth. I highly encourage you to download that report if you want to sort of keep up to date on things. Anyways, see you next week.